Hello, good morning. I am Ryan Ingram, and this is the Friday morning live stream Q&A. So let me get it all set up here. Let's go to the little banners. Post your questions in the chat. Any questions that you might have, feel free to ask those. So I'm going to go over a couple of questions that I've gotten just throughout the week, whether that's in person or from the comments of the YouTube section, or our research from figuring out what people are looking for on YouTube. So we can use a couple of tools that are pretty cool that allow us to see what the most searched real estate terms are. And we try to incorporate those into the live stream so that we have some good clips that bring in some new subscribers, bring in some new views, and continue to grow this channel. Because ultimately, all I'm attempting to do with this channel is be accessible for people to ask questions to as they are on their way to forming their real estate portfolio, growing their businesses or anything like that. And, when I was first starting, I was very fortunate to be introduced to a number of mentors, number of just other real estate investors that were generous with their time and their wisdom. And they were able to, really guide me and help curve some of the bad decisions that I was on my way of making. So I would say one of the things that Will and I did best is we surrounded ourselves with people that had the types of portfolios that we were looking to grow, and we leaned into them. Each time before we made a decision, we had them, tell us their honest opinion, and we continue to do so. So we have an advisory board. We meet once per quarter. We go over all of our financials, all of the kind of the metrics that we monitor. We're going over kind of our roadmap of where we want to be in the next year, in the next 2 years, 10 years. And we are constantly asking for insight from people that have already been there, already built businesses, already built portfolios, and figure out what we're missing, if we have any blind spots, and how we can correct. And by being accessible, I feel like, to the people that are just curious, I'm able to answer questions. I'm able to provide, the unbiased opinions that I have on your situation. And I think that is invaluable if treated appropriately. And it's just really important to me to always make time. So I'm pretty excited, pretty pumped up that this is on my schedule every Friday morning. I love doing it. I love answering questions when asked. I love providing the insight that I have as I was getting started and as I was researching real estate, as I was reading books, listening to podcasts. I always felt like something was missing, and I would have loved to just have some time with some of the people that I was listening to ask some questions and get their kind of candid feedback on it. One thing that I strongly dislike is, people that put out a little bit of information and then try to sell you something on the back end. I'm not going to do that. I have an affiliate link with PropStream. You can make me just a little bit of money by watching the videos as they come out. It's a very small amount of money. It doesn't move the needle. Helps me feed my family, but doesn't necessarily move the needle on anything. I'm not overly financially incentivized to do really anything. So as far as this channel goes and the advice that I give, so it's all my actual opinion. I'm not going to sugarcoat anything. I'm not going to have a really large paywall behind any of the information that I give. We do have a mastermind course that I think it's not a course, a mastermind group. There's about 15 guys in it at the moment. We meet once a week for about an hour at a time. And there are 2 guys in the hot seat, or they're the man in the middle, whatever you want to call it, where they bring up some type of problem that they're having personally, professionally, whatever it may be, that they would like other people's insight on. And I think that's a really good format to go just a little bit deeper and get a lot of people's opinions. And, there are some very successful people in that group. Some, I can't think of the word right now, but a business coach that is invaluable to our organization and to many others as well. He's worked with some really large companies. We've got some other investors that have 60, 100 doors. A lot of people that have, more than more than 5, I would say. So it's a good group of people where you have a lot of insight. If being a part of a group of guys like that is of any interest to you, definitely check that out. But that's the only thing that I sell. That's $300 per month, and there is a hefty time commitment, and being involved in that. Definitely, you need to show up every week. You need to be present during that hour, and you need to be willing to receive feedback and also give feedback. And that's about it. Other than that, just answering real estate questions or personal finance questions is a good thing. And I'm looking forward to having done this for a couple of years pretty consistently now, and looking forward to doing it indefinitely. I think it's just going to become a pretty fun thing to look back on. If nothing else, other than being able to see what I was up to each week, because one of the first things that I do each week on this live stream is just go ahead and recap the week that I've had, talk about how many properties we've had under contract, any sort of issues that I've been dealing with. And I think that'll be fun, as the business rapidly grows. Like the problems that I'm having right now, when I started doing this around 80 properties, I wouldn't have guessed that I would have these problems. And I also, think it is fun to look back on the videos where I had 80 doors or 60 doors. I think I started the YouTube channel when we had around 60 or so. So maybe that is not completely correct, but it's close. So it's just fun to see the story progress, unfold, and potentially help people in the meantime. So I do get a decent number of thank yous randomly, and they're always very appreciated. All right. Let's see. So today we are only closing on 2 properties. Last week we closed on 3. We are making really good moves. And when we first started the year, our goal was to buy 200 homes this year. Currently, we have 2 different spreadsheets here. Let me pull up the second spreadsheet. So far this year, we have purchased 171 doors. We still have 11 under contract. So once we get all 11 closed, we will have purchased 182. And we still have a couple months left. So each month we have strived to purchase 17 homes. And that would get us to, I think it's like 204. That was as close as we can get, and deal with even numbers. So in January, we purchased 11 properties. In February, we purchased 15. In March, we purchased 13. In April, we purchased 19. In May, we purchased 27. That was a big month. We bought a package. I think that's what made those numbers so high. In June, we purchased 17. In July, we purchased 25. That was a big month. And we also bought a business during that month. So that was a really big month for us. In August, we purchased 19 homes. September, we also purchased 19 homes. And so far in October, we've purchased 5. So we're well on our way. And I think we're going to finish this year strong. We have some private funds lined up that will hopefully show up in the first week of December. And that will be $1 million or $2 million, somewhere in there. So that will allow us to finish the year strong. And it's also going to make for a really busy month at the end of this month, and also November, as far as going around putting some stuff under contract. And we have gotten our vacancies down tremendously. Over the past couple of weeks, I've been talking about how we're kind of changing our strategy to not buy any more rehab projects and only purchase properties that are either rent ready or already occupied or extraordinarily light turns. And that has paid off. So at one point we had about 60 vacancies, and now we're down to 38. Now, after doing some talks with the teams, thinking through problem solving. One of the things that's really important for us is that we always have jobs ready for the contractors that are so kind to help us do all this work. So we currently have about 12 contracting crews that we keep busy or try to keep busy pretty much year round. So how we like to structure things is we like to have them assigned to a project. And then we also like to have another project lined up for them so that they have somewhere to go immediately once they're done with the first project they're working on. So in order for us to do that, if we've got 12 crews, then that pretty much means that we need to have at least 24 vacancies. 24 vacancies would probably be as thin of a number that we would like to have. So 38 is not that far from 24. And right now we have, that number is a little bit skewed because we have some properties where we have some utilities issues. They've been vacant for too long, so inspections need to be done. And once you need the city's involvement for any type of inspection or anything, that just really slows up the process and throws some wrenches and things. So that's why that number is a little bit high. Otherwise, we are almost to the point where we need to start buying some rehab projects more regularly because we need to keep some projects lined up for the people that enjoy working with us, because we definitely appreciate that they work for us. One of the questions that I had this week was, how do I run comps? And I use PropStream. I use PropStream on almost a daily basis. Anytime where I'm buying a property in an area where I'm not necessarily familiar with it, if we don't buy there frequently, then I am doing all of the research that I can on this property. And previously, before I got familiar or acquainted with PropStream, I would do all of this research myself by going to the clerk of courts, the auditors' websites, and really trying to, then I would go on Zillow, Realtor.com, and figure out, just like do a loose version of a comp report. And with PropStream, I'm able to knock out all of the things that I used to do on all the different websites with just PropStream. So that's really allowed me to streamline my research type process. So I would highly recommend, if you ever want to know what properties are selling for in the area, if you want to know who the property is owned, how many properties the people that own that one that you're interested in own, PropStream makes all this extraordinarily easy. I've got an affiliate link. It's in the description. I'd highly recommend that you check that out if you have any aspirations of being able to do your own research and have a serious amount of data at the tip of your fingers. So it's a pretty easy process. If you type in the address of the property that you're interested in, you will see that there's a tab that says comparable sales. And then what I really appreciate about PropStream is it lets you unselect all of the properties in the area. You can put in the criteria, whether it's the number of bedrooms or bathrooms or square footage, whatever information you want to use to pull those comps. It will give you all of the properties in the area that have recently sold inside the parameters that you input. You can unselect those, and it'll have links to the MLS listing or the photos directly in there, and you'll be able to see pictures of that property. And what that really allows you to do is dial in based on the condition of the property. So what I normally do is I unselect all the properties, and I will go through and individually add those. I will obviously not include the ones that were sold to investors or foreclosed on or anything like that. I would only highlight and include in the comp report the properties that are in similar condition to the property that we're working on. That allows me to get a extraordinarily educated opinion very quickly. So then I know that, if I plan on making a property top of the line and I only select properties that are in, perfect shape and sold for full retail price, now I have a very solid ARV. And if you've watched this channel for any length of time, I think the appropriate formula to purchase a property is 75% of the after repair value minus any of the necessary repairs. So as soon as I know what similar properties that are in the best of all possible conditions, once I know what that number is, I've got an ARV. So I can take 75% of that number very quickly. Let's say it's 100,000. Then I'm going to dial that number back to 75,000. So if that property was perfect, absolutely perfect, if nothing needed to be done, the most that I would be willing to pay for it is $75,000. Now, if it needs nothing with the proper marketing, there are plenty of people that would likely buy it for 100,000. However, in the event that they can't find anyone to, I'm here very happily to buy that property from them for 75,000. So if that property is not perfect, let's say it needs a new roof, that's all it needs, and that roof is going to cost $5,000, maybe $6,000. Well, now the most that I would be willing to pay for that property is 70,000 or 69,000. And you just keep doing that for any of the repairs that you're thinking about making or that you think the property needs in order to get it fully up to your standards. So it's a very, very fast formula. Once you get into the groove of this, you can do it very quickly. And PropStream has saved me at this point probably thousands of hours of research as we are looking at properties. Just last night, I was negotiating a property with a friend. They're looking to sell a property, and after walking through the property, after hearing her reasons for selling it, we were just too far off. And yesterday I walked through 3 different properties. We made offers based on that formula that I just told you, and none of those offers were accepted. So, one of the things that I hear a lot of doing this YouTube channel, talking to other investors, is, people throw out 1 offer, 2 offers, and they aren't accepted, and they'll say this formula doesn't work. And just like everything else in life and business, it's a numbers game. We have lost probably a couple dozen in the past couple weeks, and that's okay. Next year, I won't even remember the addresses of these offers, and I'm not in the slightest discouraged by these offers not being accepted. The formula works. The business model works. It's imperative that on all of your purchases that you follow this formula. And the fewer properties you have, the more important it is that you be extraordinarily rigid and stringent on keeping that formula. And if you are in a market where these properties don't exist, where that formula just isn't at all possible, then you should heavily consider moving to a market where this can still be done. One of the most important things that I think every real estate investor should know, that I feel like a lot of people just getting into it don't, is that the real estate market is not this thing that exists nationwide. There might be some kind of macroeconomic trends that's true for the majority of real estate, but when it comes to real estate investing, it is extraordinarily local. You could drive 30 minutes and it is a completely different market than where you live. And, you cannot possibly compare the California market to any market in the Midwest. Especially, I'm in Ohio. I'm very familiar with one market in Ohio. If I go 15, 20 minutes north, I have no concept of what's going on. I'm in Dayton. I don't have a clue of what the Columbus market is doing. I don't have the slightest clue as to what is going on in Cincinnati. And that's even, magnified the further you get away in places like Akron, Cleveland. I couldn't keep up. So understanding that, what's true for the broader narrative that you may be hearing about on the television or the World Wide Web, it might be true for places like California and New York, where the majority of the people that, put this content on live. But that has no bearing on the real estate market in your backyard. Elizabeth Sweet, good morning. Hey, happy to see you here. This is tons of fun. That just made my day. Good end of the week, beginning of the work weekend Friday. Yeah, there you go. Yes, your channel has definitely been helpful. Thank you, Nora Stocks. I really appreciate it. Good morning. How do you get contractors for 172 properties? The same way you get contractors for 1 property. Actually, we just had our 5th kid, and I would say that children are a lot like rental properties. There are things that get significantly easier the more of them you have. So, getting a contractor for 172 properties is significantly easier than finding a contractor for your one property or your five properties or something like that. And, I am really tempted. I really want to write a book before I completely forget about some of the pain points that we had early on, because keeping up with the problems that we have now is really difficult, and it is a significantly different landscape than when we first started. However, when I hear this question, when I hear people having difficulties with contractors, and I actually have the opportunity to sit there and think through what it was like as we were building our portfolio and what it felt like to have one property, four properties, and something needed to be done. It was so painful to get a contractor to show up. I can't tell you the number of times, especially early on, where I was stood up by contractors. I would meet contractors at places, talk to them for multiple hours, just for them to never send over a quote, never answer any of my texts or calls after that hour. Um, it's tough. I think contractors on a smaller portfolio is hands down more difficult than the residents and getting people to live inside of those properties, because I guess what it comes down to is, if it's a small job, if it's going to be a job where it's going to take them 2 days to do, then that's only going to keep them busy for 2 days. And they have, a whole month's worth of expenses to pay for, a family to feed. So the larger jobs that are going to take them 2 weeks, 3 weeks, 5 weeks to complete, it's a better bet for them than trying to incorporate a job for 2 days, because it's just more stability. There are certain things that, have to happen on jobs that take just as long to do for a job that costs $10,000 as it is for a job that costs $100. The paperwork is the paperwork. Um, Driving to the job site's driving to the job site. So for contractors, especially now, we have really eased that difficulty, as we're able to offer people, job after job. Like, so long as they continue to show up, work diligently, communicate with us when they have issues, then there's going to be a job for them to go to next. Whereas, when you are a, smaller contractor and you are the entire business, when you're the owner, when you're the operator, when you're the bookkeeper, when you're the marketer, and you have to find, job after job, it's really difficult to get enough little jobs to make one full-time job. So I hope that makes sense. And not to be doom and gloom, but to truly be kind of encouraging, I will say, if you have a smaller portfolio, please understand that getting a contractor that is going to be readily available to help you with everything is going to be the most difficult part about having a small time portfolio. And it is one of the largest reasons as to why you should keep fighting to get 10 properties, keep fighting to get to 20 properties, because I can, tell you firsthand, just as we have grown this, managing 30 properties is just as difficult as managing 5 properties. But in many ways, it's easier. And I would say, managing one property is not something that I would be interested in. And I would fight to get to 10 as quickly as possible. And then once you're at 10, I would really focus on doubling. Now, I think the 10 property mark is really important, because from a cash flow perspective, you're starting to benefit from large numbers or averages, and that, the chances of all 10 of your properties needing something in any given month is very low. So generally speaking, once you get to that 10 property mark, the other 9 are going to be able to pay for almost anything that could go wrong with the one property. Now, obviously, this is, completely subjective and dependent on the situation. But so long as there's no really large outstanding capital expenditures, that should be true. Thank you. I appreciate it. Ryan, I recently saw a short that said that banks are required to give businesses a $50,000 line of credit. Is that true? I don't think so. There have been many banks that haven't wanted to give us a $50,000 line of credit. Um, so I would not ignore that. I mean, I would ignore that. I don't think that's true. I don't know how it could be true. Because if that's true, then I think everybody would have a business and everybody would have a $50,000 line of credit. And that's not the case. So, I see a lot of YouTube videos and a lot of shorts from people that don't have businesses, that aren't independently successful, don't have necessarily a track record. Yet, one of the first things they want to teach people is how to build business credit and how to get lines of credits or loans on this newfound business credit that's independent of their credit. And I think that's a bad message to be giving people, and I don't think it's something that anyone should really attempt to do. I think you should spend your time not trying to figure out how to get business credit out of thin air and subsequently lines of credits out of thin air, but I think you should spend your time on trying to build an actual business that provides value to the community around you. And I think in the long term, you're going to be significantly better off, more well respected by banks, and get significantly higher dollar values on your lines of credits when you actually have, substance to show the bank as either collateral, as a business model, a proven track record, and a long line of happy clients. So that's my answer on that. I have tried so hard, especially early on, to understand more about, building business credit, qualifying for business credit cards, and 100% of the time, my time has been better spent not researching that, but actually working on building my business and providing value to our community. So that's the advice that I would give anybody that wants to get some phenomenal, credit products from banks. And that is to build a business so strong that banks are competing to lend to you. And that's probably the best place to be. If you watch enough YouTube shorts and you're interested in businesses, you're going to inevitably stumble upon a clip of Mark Cuban saying that anybody that starts a business and takes out a loan is a moron. Those are Mark Cuban's words, not mine. But I would have to agree that it's significantly better if you have the opportunity and the ability to build a cash flow value add business without any overhead costs or loans to begin with. So I have some really good friends high up in like the consulting space and the tech space, and I can't for the life of me figure out how some of them make money. And turns out many of them don't. A lot of the things that venture capital, that angel investors, kind of gamble on are these businesses that are actually losing money because they don't actually have like a product to put to market. Or if they do, it's not one that actually makes money. And right now, those guys can get funds from venture capital or angel investors. And, but whenever it's time to actually do real stuff, I think they're gonna close their doors pretty fast because they don't actually provide a value or something new to the marketplace. So I would say it's a good thing and a good general rule to not expect something for nothing. And starting a business and getting a line of credit, we're saying that banks are required to give you one. I don't know. Some people do weird things to get views and get more clicks. And I could see how someone would take something that may be true, in that banks don't like giving lines of credits less than $50,000 to business, and skewing it in a way that is more appealing to click on by saying that banks are required to give you a $50,000 line of credit. But I don't know, especially on the business side of things, on the commercial side of things, I would say that if a bank is going to keep something in their personal portfolio, then it's really up to the bank. So, one of the things that I've kind of lost sight of telling people or mentioning on this channel is just as hard as I look for properties for us to purchase, my brother is, looking for banks that are willing to work with us based on our business model. So banks have options, bank has choices. Not all banks are the same, and banks have different, preferences, requirements, and appetites for what they lend on. So, I got a question yesterday from a fella saying that he was looking for a bank that would use an appraisal that he already had done because he wasn't happy with the bank that ordered the first appraisal for something. And he wanted me to give him like a name of some banks. I said, no. I said, just call around. Like, we run two completely different businesses. You are better off spending your time on calling, 2 dozen, 3 dozen banks, figuring out, what their guidelines are and how, like, which ones would be willing to work with you given your circumstance, because each bank is different. And just like everything in life, they're largely relationship based. Really loving this contractor perspective, something many do not understand, but once understood, it's easier to offer what contractors need and not to get frustrated personally. People talk about the local market slumping. A, is it? B, are you buying regardless or stocking cash for the bottom of the market? That's a really good question. People talking about the local market slumping. So I'm going to take this question and talk about Dayton specifically. And I will give all of my personal opinions about the current market in Dayton. So as far as the slumping goes, I'm going to take that as meaning that properties are sitting on the market for longer and that more price decreases are happening because they're sitting on the market for longer and these homes aren't moving. And this is kind of one of those two-pronged answers, right? So first, I'm going to say, yes, it is. There are properties that have stayed on the market for a very long time, and there are a great number of price decreases currently happening. However, I would say that these are not important metrics in the sense that they're generally, applied for. And I would say that, the market here has gone up so fast that now I feel like you have a lot of people that have wanted to sell homes or are interested in selling their house, and they see how low the inventory is. They see the comparable sales for homes in their neighborhoods, and if a home in their neighborhood has sold for 100,000, and historically, they view their property, they purchased it, 5-6 years ago for 30 grand, 40 grand. They're going to say, okay, well, if that property sold that's 1,200 square feet for 100 grand, then my property should sell for 100 grand. So right now you have a bunch of trash with deferred maintenance, with sloppy rehabs, with corners cut, listing on the market for 100 grand. And, unlike the first property that sold for 100 grand, where somebody rehabbed it, to the best of their ability, everything looks fantastic. For the most part, everything is new in it. There's no deferred maintenance on the property. You've got, people that haven't done anything, and they're trying to, at this point, the inventory is just so low where I don't feel like there are enough people in this market that are rolling out high quality flips. You've got some people flipping properties and there is, a half inch of caulk on the back of their granite countertops. And people go through that and they see how sloppy this work is done. Sure, the right materials are there, but the craftsmanship is horrible. There's funky smells in it. There is a cast iron stack in the basement that still has a clear crack in it. So as soon as somebody moves in, that's going to be an issue. They rehabbed the whole bathroom, but for some reason kept the green tub, right? Why? And these are the properties that are sitting on the market for obvious reasons once you look closely. And these are the properties that are taking price decreases, as they're sitting in the market. So while a slump is happening, I would say it's because there aren't enough quality products inside of the inventory. And subsequently, you've got a bunch of trash now listing itself for, top dollar when it can't call for such. So these properties are listed for sale for a month, 2 months to see what happens. They'll decrease the price occasionally. And then once there are no takers, they're going to take it off the market and use it as a rental until, they can collect more deferred maintenance and, list for lower in the future or recover some of the funds that they think they put into the property. I don't know. However, in saying all of that, I will say that I still see when a property that is priced appropriately, whether it's high or, middle of the road, if it's like this property that I just used in this example, if they actually listed it on the market for $40,000, it would sell. But they're trying to pawn it off as this $100,000 property, and that's just not going to happen. Inventory is low, yes. However, we're not in this market where people are willing to pay more than they should for what they're getting. So all the properties that are appropriately priced or well rehabbed are going very, very fast, and we're going to list a property for sale here soon that is one of the first that we've ever done. We are, trying to sell a property that we just renovated. And in my opinion, we left no stone unturned. We didn't cut any corners. It's not going to be the most profitable thing that we've ever done. We might break even, but it's a really good house. And we're going to list it for what we think it's worth, which, since we just put new everything on it, we're going to list it for, top dollar and see what happens. And I am going to be more than happy to report back on how that goes. And perhaps that will change my opinion on what was just said. But hey, I think, from what I've seen, we're still in an extraordinarily strong market with very low inventory. And, I have been putting in kind of low offers on the MLS. And what has happened very frequently is that, a property will list itself or get listed for 60 grand. And I'll look at it and I'll say, okay, I'll use that formula that I talked about where 75% of the after repair value minus all the repairs. I'll go through it. I'll figure out, what a fair price is, and I'll offer that. And it's a fair price. A lot of times we're told no, which is fine. I hope they can sell it for more than what I think, because that means that the market is still going up. However, a lot of times what we have experienced lately is 3, 4, 5 weeks later after they get offers, but then, those people let the deal fall through because they walk it, they smell it, they see all the deferred maintenance, they see all the corners cut. Sure, it took great pictures, but when you get up to it, it is not good at all. And then eventually, these people will come back and say, hey, we will accept your offer. Or they'll turn it into a rental, which is kind of sad in its own merit. But that's my personal assessment of the market. I watched this fascinating video recently from UCLA talking about the current conditions of the economy. And they were mainly talking about where they were out in LA. But one of the points that the guys made was he said that he's starting to see some statistics pop up, and this was in June of this year, so it's a little bit dated, but not too much. He said that he was starting to see some statistics of, hey, people like panicking because the inventory has increased by 20 or 50%. And his whole point was, well, if you look further than like the past 2 years, then inventory would need to triple in order for us to get back to our like old normal. So the inventory is so low that it needs to 3x from where it is now in order for us to get back to the levels that it was, kind of pre-pandemic or whatever marker you want to use as an indicator. So you should keep that in mind as well when we're talking about inventory, because a lot of these, from Mark's question to your question, people on YouTube say a lot. People talk a lot. And last week on this live stream, I went through the little app that suggests video topics, and almost all of them were, asking me or predicting high views if I were to talk about things crashing or things slumping, or the housing market failing, or the upcoming crash. And if you look at some of these real estate YouTube channels, you'll see that the entire time that their channel has been around, they've been talking about market crashes and housing crashes, and the way that it's titled, and the way that they've kind of optimized it, the way that they've made the thumbnail with like the fire in the background in big red letters. It's really doom and gloom. And then they might try to save themselves and say, hey, it's clickbait. I actually think that the market crash is not going to happen. Some of them do that, but still, like, why put it out there like that? Why make people click on something and state that your opinion is opposite of what it really is, just to get views? I think that's really disingenuous, and I don't really think that is like a really long-term way of getting, subscribers that value your opinion. You got to get burned out at some point on that kind of stuff. So, and then I also think from the local economy and real estate investing as a whole, I would say that, and again, from my investing career so far, we have not yet invested through a downturn. Since we've been buying properties in 2017, the market has only gone up. So it's not like I have a seasoned, expert, veteran opinion on this. And my words could easily bite me as time reveals itself. But in all my research and all my talking to mentors and all the interviews that I've done with people where they did lose everything, I would say that if you have the means to pivot, if you are staying agile, if you're not afraid to change your strategy as the market conditions change, then you're going to be okay. If you are consuming a lot of this doom and gloom content and you want to not feel like the world is falling, then you can research some companies that started during the Great Depression years. And if you look at all these economic downturns, if you do the right amount of research, then you can find companies that are, large staples in our, society or personal consumption at this point, were started during the Great Depression years. So there's always going to be a way to make money. There's always going to be something that you could do to turn a profit. You just have to find that. And if you get an indication that your plan is not working, then you should likely change it. And, we do our very best to stay on top of the market, on top of our strategy, figure out where it's working, figure out where we might have faults, and figure out in what ways we need to change. And one of the things that I would say in thinking through this and in seeing the way that the market is changing is, as interest rates, which are for sure going up, continue to go up, then what that's doing is limiting the buying pool. Now, on one hand, since the inventory is so low, it doesn't necessarily matter how many buyers are in the market, because the inventory is such that everybody that wants to buy a home doesn't have the ability to do so. However, as financing is more expensive, turning quick cash flow becomes more difficult. And as that becomes more difficult, the purchase prices are going to fall a little bit. And I heard this really cool quote. I don't remember from where, but I really enjoy it. And that is, marry the house and date the mortgage. So as you have the opportunity upcoming to purchase properties for lower than usual, you should do so. And once the interest rates start lowering themselves again, you can refinance. I was watching, some video recently, as I'm sure many of you were as well, that were something about how horrible the economy was. And this whole article, the premise was, compared to how low rates were previously on like a $400,000 house, over the 30 years that you're going to have that mortgage, you're going to pay $360,000 more over the life of that loan on interest alone, which is just unaffordable for so many people. And fundamentally, I just disagree with that perspective because nobody is going to hold a mortgage for 30 years. I think uh, the number of people that keep the same mortgage, especially as one of the things that is fun about real estate is when you refinance. For the most part, it's a tax-free event. So if you have the ability to buy a house for cheaper now because more people are not interested in holding that monthly mortgage payment or paying that, then hey, buy the house now. Suffer for it for now. Don't look at the 30-year accumulation of how much interest you're paying. Know that you're going to refi 3, 4, 5 years down the road whenever the interest rate's lower to a point where it makes sense, right? Unless you're one that's predicting that the interest rates are going to stay high forever. But I think that is the more appropriate way to look at it. So, our initial basis on properties may get lower. Yes, for a short period of time, the amount of cash flow that we're able to make might be lesser. However, if you look at it, once we have the opportunity to refinance multiple of these at a time, the cash flow is going to increase. We're going to have a windfall of cash flow once interest rates lower and we're able to refinance on the assets that we were able to purchase for lower during this time when people are talking about the recessions or such. So I would say that is our plan. We're going to continue to buy. We're going to be acceptant of the fact that the more mortgage rates and the more interest rates increase, that's going to hurt our cash flow. However, so long as the values of the homes don't tank, by like 50%, then the purchase prices, our new purchase prices, are going to give us a higher equity. And in the future, we'll be able to pull out more of that equity on a tax-free basis as we refinance. So yes, you're going to sacrifice some short-term cash flow as interest rates continue to rise. That's a fact. But if you are able to, with these higher interest rates, still acquire properties that cash flow, you should do so. You shouldn't speculate on appreciation. You shouldn't speculate on what the economy may or may not do. You should continue to use that formula. I would say if you can find a property that fits the mold of, you can buy it for 75% of the after repair value minus any of the outstanding repairs, and you can rent it out and the property still cash flows after all of your expenses, even if it is, $50, $100, you should do so. And then when interest rates go from 8% to 5%, that'll increase your cash flow on a monthly basis. Your cash flow will go from $50 to $100 to $200, $300 per month, right? So that's what I would suggest. I would not slow down. I would pivot. I would keep that long-term perspective. We're not going to slow down in buying homes. We're just going to be accepted of the fact that interest rates impact cash flow. And to couple that, to add on to this point, I know I've really been rambling on this for a long time, but I would say that right now, as part of the mastermind, we're going through a book about Charlie Munger, and we're watching a lot of interviews that he's done. And one of the things that he said that really resonated with me and made me pretty happy was sometimes the tide is against them and sometimes it is with them. But regardless, he keeps swimming. And I think that is the perfect way to look at the market. Yes, sometimes the market is going to be working against you and your business, but that doesn't change the fact, that doesn't make someone say, I need to get out of business. Maybe pivot a little bit to stay profitable, to increase revenues. But yeah, the market's against you. And then other times the market's for you and everything is pushing you in the right direction. Everything is, your asset values are increasing. Your cash flows, your rents are going up. Your cash flows are increasing. And those are great times to do business. Those are times when a lot of people that don't take this too seriously, don't do the research, don't analyze the deals as strictly as they should, also hop in. And then as soon as the tide gets against them, they're going to start falling out. And Warren Buffett has a good quote that says, it's when the tide goes out that you see who's been swimming naked. And I think that's a good quote. And I think all of this goes together. But I would say, from a fundamental perspective, if you are buying good properties, if you're buying cash flow assets, you should continue to do so. One of the guys in the mastermind who owns a hundred or so, a little over 100 doors here in the area. He has, I think he bought his first house in like '06 or something like that. He invested, all the way through the crashes. And he said, hey, for real estate investors, recessions and downturns really mean that you need to double down and you need to buy more assets during that time. And he said, if I got to do 2008 again, I would buy twice as much as I actually did. And I think that has some weight to it as well. So if you put all of this together, I would summarize and be overly harsh and probably a little bit exaggerating in my closing statement of the people that have the opportunity to say things likely are not the ones doing it. And the people that are doing it are going to continue to do it. So all the people that are incentivized to make these videos talking about how horrible the economy is and how everything is falling, they're not actually out here doing anything. And if you start listening to people and weighting their words based on the accomplishments they have in the past, I think it really spells out a different story. And you've got, a lot of people on YouTube that have massive followings that have no real life accomplishments, but they're the ones that are trying to coach you through this next recession. So be careful, really be mindful of what you put inside of that very, very important, very powerful brain of yours. Listen to people like Howard Marks, read his book, The Most Important Thing, that was written kind of during or right after the 2008, the last crash. Invaluable book. I've read it a couple times now, and I'll probably read it a couple more. Charlie Munger, listen to a lot of interviews, read the books about him. Same with Warren Buffett. Charlie Munger's 98 right now. I think Warren Buffett's 92. They've lived through and seen a lot. So that's what I would say that we should all be doing. Good morning. Not every local market is slumping, since every market is local for different people. Exactly. There's a decent amount of correction going on, but if the numbers work for you, they work. The good thing is you can refinance in a year or two if you buy now. Exactly. Hey, I'm with you. I am with you. All righty. It is 8:54. We've got 13 people on. Been doing this for 52 minutes. Our first closing for the day is at 9:30. So I'm going to need to leave here shortly. But any questions that you have in the next few minutes, I'd be more than happy to answer those. The title of this live stream is 7 Steps for Getting Started in Real Estate Investing. So I know we haven't quite covered that yet, but all of the conversations that we have had so far have been spectacular. In fact, the only thing that I planned on talking about whenever I started this live stream this morning was 7 steps in getting started in real estate investing. So now that I haven't done that, I will likely go ahead and change the title once this thing closes out and forget it ever happened. Cover it next week. That's what we'll do. We've done a couple of videos here lately about HELOCs versus cash out refi, and that has caused for a lot of really good conversations from people in comments. And real quick, I just want to do an overview and explain HELOCs and what they are. And ultimately, if you have a house that you've either lived in or an investment property and you've owned it for any length of time, what you're going to see is each time you pay the mortgage, you're going to pay down a certain amount of the principal. And each time you do that, you have more equity in the home. Well, if you are one of the people that have purchased a property recently, or you got a really low interest rate up front, the chance of you wanting to do a refinance anytime soon is probably really slim, since interest rates have gone way up. So one way that you could tap into that equity and utilize it for additional investments, albeit just investing in the market, which I don't think is a good idea, or buying additional real estate assets, or we've got some of our private lenders who use their equity in their home to do hard money loans and private lending for us. And we acquire and rehab properties and just pay them interest on a monthly basis. So you're able to do a lot of really cool things with the equity in your home. And if you're not interested in refinancing the main mortgage that you have, then the main tool available to you is a home equity line of credit or a HELOC, HELOC. And ultimately, it operates very similar as a credit card would. You do not pay. Let's say you have a $50,000 home equity line of credit. If you do not use any of that money, then you owe no interest on a monthly basis. However, if you spend $50,000 of that, then you only need to pay back the interest of that on that $50,000 while that is deployed. And then the moment you pay back that $50,000, you no longer owe any interest again. So it's a pretty fun tool, pretty powerful. Most home equity lines of credits have like a 10-year borrowing period and then like some number of years of payback afterwards, where if there's still an outstanding balance, you're not going to be able to borrow against it. They might amortize it out for you so that you can get it paid off. But I will say that as you're utilizing these home equity lines of credits, the only thing that I would use it for is acquiring additional cash flow assets or making investments that have cash flow associated with it. So I wouldn't do anything speculative where you're buying like a cryptocurrency or a stock that you are expecting to go up, but in the interim, pays you nothing. I think one of the most secure things that you could do with your funds is use a home equity line of credit on a cash flow or income producing investment, and then use those funds to pay back that home equity line of credit and kind of profit off the delta. So if you're able to, because these home equity lines of credits are collateralized with your home, generally you're able to get a lower interest rate on them. So we have some of our private lenders who will have a HELOC at 5 or 6%, and then they'll lend the money to us at 12%. So they're making 6% on essentially, not really doing anything, but utilizing the equity inside of their home. So it's a really, really solid option for people that were able to lock in great first position mortgages and are sitting in a spot where you have a lot of equity inside your home and you're looking to deploy it. So if you live in the house, it is significantly easier to get a home equity line of credit. If it is an investment property, then you are going to have a lot of calling banks ahead of you to figure out which of your local or regional banks are interested in doing a line of credit on top of an investment property. It does exist. We have done it. However, they're hard to find. It's a very difficult and rare product. So in the event that you find it, definitely let anybody else know that has some high equity rental properties and that bank did that for you. And then you'll make a lot of friends really quickly. Thank you. Yeah, I appreciate it. All right. Well, that is all I have. If the mastermind's of any interest to you, feel free to check that out. In the meantime, definitely read Howard Marks' The Most Important Thing. And I would also recommend reading some books about Charlie Munger. And the more that you start hearing about recessions, I would not pay too much attention to the noise. Don't watch the news. Don't watch people that label videos with doom and gloom type stuff. Really start researching the people who made a significant amount of money or started businesses during recessions in the past. If it's coming, be prepared on how to invest during a recession. And I think, your best bet in investing in recessions is by betting on the fundamentals, by making sure that you're buying properties based on the formula of 75% of the after repair value minus the purchase price. Minus the rehab costs. And then on top of that, so long as that property cash flows, you're going to be good. You're going to have the staying power to make it through the recession, and you're going to have the ability to experience a windfall of cash flow on the other side of this when interest rates come down and the asset prices continue to increase. So don't wait. Do not choose to sit on the sidelines. Just because something is going to affect everybody doesn't mean that you and your personal life have to push the pause button on building your business or achieving financial freedom. It's going to look different than you originally thought, but or maybe it's not. If you chose a really conservative way where you said, hey, I'm going to follow this formula and only buy cash flow producing assets, then probably not much is going to change, except you're going to have more deals available to you as more people don't and learn that they don't have the staying power or the interest or the ability to hold on to that asset through a recession. So pivot, don't give in to any of this, and know that you still have the ability to be profitable, to grow your net worth, to solidify your legacy, to build up wealth to pass down to future generations, and everything's going to be okay. All right, that's all I have. I'm going to go buy some homes, and I hope to hear of you all doing the same thing soon. So next Friday morning, 8 a.m. Eastern Standard Time, I will be right here. Bring a cup of coffee and your greatest questions, and I will talk to you soon. Thanks.